You're listening to the Pursuing Alpha podcast, hosted by Charles Brandon Snyder.
Well, Spencer Bryson, I appreciate you coming on.
Yeah, of course. I appreciate you having me.
Yeah, man, this is impromptu to say the least, right? But
That's right.
We knew you were coming to town, and Ryan, our producer, was just like, "Hey, let's have him on the podcast," because I think your skill set and what you do is so interesting. It's one of my favorite things to talk about and play with. But so take a minute and explain kind of who you are, where you came from, what you do, and
Sure. So I am a partner in our mergers and acquisitions and corporate law section at a law firm called Calhoun Bell and Seacrest in Dallas. But I'm originally from Plainview. I actually just got back from seeing family in Plainview. Was coming through, wanted to come say hi to you, and now I'm on my first ever podcast. So
you didn't know what you were going to get yourself into, did you?
No, but you guys poured some whiskey, and one thing led to another, and here we are talking on camera. So,
That's great. It's great. So there's so many ways I want to take this, and this is going to be such a great conversation. So a lot of people don't even understand how complex M&A is.
Yeah.
Right. And then small business owners, because this is kind of what this podcast really tailors to, is small business owners.
Sure.
We have a lot of attorneys and CPAs and just other business owners come on and just kind of tell their story of where they made money and how they got into it.
Right.
I think your story is incredibly awesome because the complexity of M&A is really, and I think it's more the merger thing that is a lot harder than, maybe the acquisition side is too.
Sure.
But it's also, I think you could speak towards a lot of the businesses I deal with want to exit someday.
Yeah.
Right. And how to do that the right way. So, let's break it down into three different ways, unless you have a better way on this. Like the merger side of this is like, hey, we're then two companies then come together, right? I'm trying to buy out somebody, and then how in the hell do I exit the most efficient way possible?
Sure.
Because you got to look at it from a legal side, then you got the tax side, and then what are you going to do with your money? So on the merger side, I think that's the harder one. Would I be wrong on that, or is that?
So it kind of depends on what you're looking at. So, one of the things that you mentioned that I think is absolutely true and I love is that my job is 3 or 4 different jobs all rolled into one, right? So on the M&A side, I need to know corporate law really, really well. The formation of entities, who your ownership is, what's allowed, what's required whenever you buy or sell a company. I also need to have a fairly good, understanding of tax. I need to understand, how taxes work with someone like you who's going to assist in managing money after a liquidation event. And all of these things tie into buying or selling a company. And especially on the, if we want to kind of talk about the sell side first, because, a lot of my work is on the sell side. You also have to have a few other hats that you're wearing. So not just being really good at the legal work, sort of the practitioner of law. That is, probably the most important. But the other aspect of this is you need to be a really good partner with these sellers as they're going through it, because most of my clients are family-owned businesses. Almost all of them are family-owned businesses. A lot of these businesses have been in these families for multiple generations. And there's a lot of emotions. There's a lot of sort of psychology that goes into this. And if you think about it, most of these folks, most of their wealth is tied up in this business. And, they hopefully have had a very comfortable life, and hopefully they are able on a year-to-year basis make distributions and, take their kids to Disney World and pay the mortgage. That's great. That's wonderful. But most of their wealth is probably in the equity of this company. And you get to sell it exactly one time.
Sure.
And so I think that is why it's important to make sure that you think through this really well, but also have somebody that you're working with who can kind of walk you through the steps and make you feel comfortable through all of it. Because it's possible that, you work for 40 years and then you're going to have 3 months or 6 months at the end of that 40 years that is going to be the wrapping up of your entire life's work all at once and making sure you want to get that right whenever you do it.
Yeah. The order of operations is what I always find that's the most important, that I always see screwed up the most. A lot of guys they go talk to their generalist attorney, which is great because they've been with them for 20 years,
course.
right? But the only problem with is I don't think they specialize in that unless they really have a good tax background.
Right.
I got one guy local that's like just a great friend of mine, and he used to be a CPA, and now he, does a lot of estate planning, stuff like that. But he's really good on exiting, right? Because he understands that side of it as well. So, and I think a lot of attorneys don't do that. But the amount of time I get calls on people that are like, "Hey, I want to sell my business. Can we get it done in 90 days?"
Sure.
Right? I'm like, yeah, most businesses take like 1 to 2 years to sell. And I think that's the disconnect.
Yeah.
And then the order of operations, what do I need to do, right?
Yeah.
How do I need to prepare for that? And I think we get brought in on the very back end after the transaction's done or when it's done.
Yeah.
And I think that's a mistake that we try to rectify early on.
Yeah.
Is because being in the conversations early on, we come from a different perspective of, hey, you got some real estate here. Let's 1031 that so we can mitigate taxes if you're wanting passive income somewhere else.
Right.
There's all these other stipulations you can go to that sometimes the attorneys or the CPAs are in their wheelhouse and they're going down their path and they don't see the bigger picture all the time. So from the attorney standpoint, what on the M&A side should you consider first? And what's that order of operations that you typically need to go through if you're selling?
Okay, so that's a really, really good question. So frankly, let's say, hey, I'm, in my mid 60s. I want to spend more time with my kids, more time with my grandkids. I'm thinking about hanging up the spurs. That's great. You need at least a year, maybe 2. And there's a couple of things you're going to do kind of initially. So depending on, if you know who you're going to be selling to, and that's not terribly usual. Usually you're saying, all right, well, I know I want to sell, but I don't know how much my business is worth. I don't know who I'm going to sell it to. If I sell it, I don't know if I'm going to get all of the money off the table or if I'm going to be expected to roll my equity, some of my equity into the new company. There's a lot of complicated questions. So typically the first people you want to talk to are your wealth advisor or your financial advisor. You want to talk to, somebody who's going to help you sell, either a business broker or an investment banker. And you're going to talk to your CPA. Those are kind of your first 3 folks, because there's a lot that you can do from a tax perspective, and there's a lot you can do from a planning perspective, estate planning, that you want to be thinking about well before you start to engage an attorney and spend money on that. Okay. So, you want to make sure that you have your numbers right. And that's going to be, working with you or somebody like you and the alpha team to say, okay, I think this business is worth $5 million. I think this company's worth $50 million. Well, you need to talk to your wealth advisor to find out, okay, if it is worth that, if you do get that, is that going to be enough money to do what you want to do? Whether that's retire and have a good, secure rest of your life, put your kids or your grandkids through college, to set up whatever sort of charitable gifts you want to do. You need to speak with somebody like, you and your team to make sure that that is enough money. But even aside from that, you need to talk to either a business broker or an investment banker to say, is this a reasonable amount? I mean, there's lots of things. I wish I had a bunch of stuff. I wish I could sell something for X number of dollars. Is that realistic? In this market, would somebody buy my company at all? And if they do, are they going to, pay me what I think it's worth? Because that's going to drive the bus a lot on whether or not you ultimately end up selling and how long it's going to take for you to sell.
Yeah. So, and this is how me and you met.
Yeah.
Is because our valuation analyst that I use is Eric Priamo. He's been on here. He's a great podcast. Y'all need to check out the podcast we've had with Eric.
Sure.
But Eric brought you into one of my deals that I was doing, and we became pretty good friends since then. But the point you're making there is, I would say that 99.9% of business owners have so much sweat equity and so much blood, sweat, and tears into their business. They don't know what to value it, one problem, but they always overvalue it typically.
Yes. Yeah.
And it's, we bring in like an Eric, a valuation analyst to go like, before you even go waste your time with, all of the other professionals, because you cost, CPAs cost, right?
Yes.
Business brokers cost. There's a lot of those guys out there, and a lot of them will tell you what you want to hear,
Right.
instead of what the actual truth is. And so this non-biased is what we kind of pride ourselves on, because we don't make a money. Like a business broker is going to tell you, yeah, we can sell it for $20 million. And oh, by the way, I get, $10,000, $20,000 up front.
And sign this agreement, exclusivity.
Yeah. They get all that stuff. And then they get that retainer up front, and they do all these things, and then they can't sell it because the valuations are out of whack, right? And so having a realistic value, I think, is one of the biggest things that most people, they don't do.
Right.
And they look at it like, man, I just worked in this company for 40 years. It's almost like a child of mine. I've grown it and I've done all these things. What do I do when I get out? Right. That's the hardest part. So I think that's a great starting point of having the proper valuation done.
Yeah.
I'm not saying it's good or bad to have somebody to pay for a valuation. I actually think it's better to pay for a valuation, but I want you to make sure that you're paying for a Gnostic, somebody that doesn't have skin in the game. Right. Instead of somebody that's saying, yeah, I'll do this cursory valuation for 10 or 20 grand, usually what we hear. And then we'll roll that in if we sell the business and we have exclusivity for 6 months or a year to sell it. And then they set on it.
That's absolutely right. And I think one of the things I have seen that has been most helpful is, to your point, there are a million business brokers out there. There's a lot of, investment bankers out there. And what I've seen is that this business, more than any other business, if you do a bad job for somebody, that gets around pretty quick. And if you do a good job for somebody, that gets around pretty quick. So anybody who's listening to this, I recommend, if you're looking to sell your business, ask around a little bit, talk to your friends who have sold their business, talk to your attorneys, talk to your CPAs, talk to your wealth advisors, and see who they recommend. This is one of those ones, like I said, you get one shot at this. I don't know that I would go on Google and type in, Lubbock, business brokers, and, whoever pops up first, whoever pays the most money for marketing pops up, and just go with them. Maybe they're great, maybe they're not great, but I would recommend, talk to the people that you do trust, that you have worked with, and rely on them to get a couple of different references. Go meet with those folks, whoever you get the best warm fuzzies from, kind of take the next step with that.
Yeah. Your gut usually tells you the right thing real quick. Right?
Yeah, it does.
And so the second deal, so when you get involved is typically after that exposure of saying, it's typically when there's a buyer already involved, right?
Yeah. So there's a couple of points where I can get involved. Usually I get involved either right before or right after the LOI. So from a start to finish kind of perspective, the way it looks for a seller is they go and they talk to their wealth advisor, their CPA, they go talk to a business broker, an investment banker, and they start the process of going to what we call going to market. That is determining how much your business is worth, and then going out and finding a bunch of folks who would buy your business for an amount that you'd be comfortable selling it for. That process can take a few months. It can take a few years. It depends on how big your business is and if it's got any hair on it, and how sort of niche or specialized your business is. The more specialized you are, the longer that period takes. After you think that you have the right one, or maybe the right two potential buyers, the next step is to put together what's called a letter of intent, or an LOI. And that is going to be a non-binding piece of paper. It's usually 2 or 3 pages that says, all right, buyer's going to offer me X, Y, and Z amount of money. It's going to be structured this way. And if buyer agrees and seller agrees to sign this letter of intent, like I said, non-binding, it's just saying, hey, we like each other, we're going to take the next step. Then after that, buyer gets into real due diligence and really starts looking under the hood and doing a bunch of reviewing of documents and talking to people. And that's where things start to get, a little bit more real for both sides. So I'm usually brought in right before the LOI or right after. It's my preference, go hire your M&A attorney right before the LOI, because there are things as seller's counsel in mergers and acquisitions that you can negotiate in the LOI that will make a big difference later down the road. Whenever we're talking about indemnification, whenever we're talking about what we call baskets and caps, which are, if you as the seller have a breach of your purchase agreement, sort of an accidental breach where you make a promise that you thought was right, but maybe isn't quite right, what your total exposure might be. We can negotiate a lot of that in the pre-LOI phase. And that can save you a bunch of money, a lot of heartache, a lot of arguing with your buyer, later down the road. So that's where I usually get brought in, is right before the LOI or right after the LOI. And then the next step after that is really heavy due diligence, where both buyer, the buyer's going to be looking at every single piece of paper, every single dispute with an employee, every single customer, every single vendor that you have. They're going to be looking at those, over the next 2 months or so, and they're going to be questioning everything that you ever did in your business. And it's nice to have an attorney at that point to kind of help talk you through what they're going to be looking for, why they're looking for it, and what is an important, red flag and what's a less important red flag whenever they bring those up. And then after that, we kind of move on to the drafting of the documents. And that part is pretty self-explanatory. We can get into that more if you like, but those are kind of the stages.
Yeah. So I would say a lot of people don't, when you sell a business, it's probably the hardest 3 to 6 months I think I've ever seen. Like, a lot of people think, hey, I'm just going to go sign this document and then, it's going to be, it's done, right?
Right.
Like, really good buyers of businesses now, especially now because it's become a thing. Like, you can see a lot of influencers now going into it. Now the due diligence period is pretty rough.
It's very rough.
It's probably been like that for a long time as the companies get bigger and bigger and bigger.
Yeah.
But if you're looking at that, $1 to $3 to $5 million business that sells, I would say I haven't seen that as been as arduous, but now it's becoming that way more and more.
Yeah.
Just being prepared that you're fixing to have, when they say they look under the hood, it's more of a colonoscopy.
Yeah,
for certain, you know what I'm saying? They're really doing some due diligence.
They are. So this is...
If they're good.
Yes. And most of them, not very many buyers are looking to spend millions and millions of dollars if they're not pretty serious about it, right? So at the point where you are selling your business for a pretty good sum, most of your buyers are going to be fairly sophisticated. Most of them are going to know what they're doing, at least enough to be very thorough in their due diligence. So one of the things I've been telling my clients for a really long time, and this has always been true, is imagine how much blood, sweat, and tears you put into your company from the time that it was a little baby and you had just formed it or you took it over from your parents. All of the blood, sweat, and tears, all of the energy, all of the late nights, all of the anxiety, all of the happiness, all of that you experienced over the course of 5 or 10 or 20 or 30 or 40 years, you're going to feel all of those emotions all over again in about a 60 to 90 day, after signing the LOI, 60 to 90 day sort of compressed period. It is going to be all of that, but in a sort of supernova package. And you're going to have a buyer that you have probably never met before, you kind of went to market. And they're going to be looking at everything you have ever done. And they're going to be questioning, why did you do it this way? Why did you do it that way? I wouldn't have done this. Did you realize that this cost you this much money? And if you would only been doing this, you would have been this much more profitable. And that's not, they're not saying it to be mean. They're not saying it to throw you off your game. It's just kind of the way this process works. And so,
they're looking for opportunities too.
Of course. They don't want to buy a business that is maxed out, that was running perfectly. So you as a seller need to be really, really conscious and thoughtful of the fact that this is going to be maybe the hardest 3 months of your business life, maybe not personal life, but hardest 3 months or 6 months of your business life. And for these family-owned businesses, most of the folks that I work with, they're still running their business, right? There's not a board of directors who's kind of handling this, and then you still have your president and your GMs who are running it. No, you're wearing all of the hats. So you're spending 8 hours a day in the data room looking at the due diligence. You're talking to your attorney, you're talking to your CPA, you're on the phone with a buyer and you're arguing with them about this and that. And then you're also having to deal with HR and your AR and your AP, and you're having to deal with this customer who is grouchy about X, Y, and Z. And there's just not enough hours in the day. And it's really, really hard for that reason.
Yeah, that's I'm glad you brought that up, because I think that's something a lot of people don't understand. You're doing 2 40-hour jobs all at the same time. And that stress starts piling on. And it's not like, hey, I'm doing a 40-hour job and then another one for a week or two. It's months and months and months. But there is a very good pot of gold at the end of this thing. And there's a silver lining to doing it, right? But I think a lot of people kick tires on selling their business just to kind of get the warm and fuzzy feeling of what they think their value of their company is. Sure. And then you got the ones that are like, no, I need to exit, and I need you to help figure out where to exit, right? The other side of that coin, though, is there things you can do? You've been out part of hundreds or thousands of transactions, right? That if I'm saying in the next 2 years, I'm fixing to sell my business, is there things you can do 6 months before even finding a buyer to make you look more attractive?
Yes. So absolutely. So what you want to do is you want to get with your CPA, and depending on who your CPA is and what kind of services they offer, you might need and depending on who your CFO is, if you have a CFO, maybe want to kind of look at a sort of an outside or third party fractional CFO, because one of the things you're going to want to do before you go to market is you're going to want to make sure that your books and records look really, really good and really, really clean, and everything is in the right columns the way that they're supposed to. Now, it's going to do a few things. One, it's going to make your due diligence process go a lot easier. And then two, whenever you go and you're doing your pitch to potential buyers, it makes you look like a really good, well-oiled machine, and that's going to increase your purchase price, right? And that's sort of the ultimate goal, is to make sure you get out of this with as much money as possible. So those things are really helpful. I would recommend talking to your attorney about making sure, if there needs to be a restructure beforehand in a way that is going to make the deal go a little smoother, or make the buyer more interested in picking your business versus another business. Talking to your attorney long beforehand, because you don't want to be doing a restructure in the middle of an acquisition. So that's going to be, all right, looking at, have I separated my personal assets from my business liabilities? If I've got real estate and an operating company, are they in the same company? Should they be? Maybe not. Are you, if you have heavy machinery, how is that structured? And is that in the same entity as your operating company? So there's a lot of things that you can do sort of on the corporate standpoint. And then the third part is talking to your financial advisor about how your estate plan is set up, because there's a lot of opportunities, especially if you're sort of charitably inclined. There's a lot of opportunities that you have that you can work with your wealth advisor to put structures in place to have a better opportunity to gift money in a way that's advantageous to you. But those things, the sooner they're done, the better. The more ahead of an LOI they're done, the better. And so those are the kinds of folks and the kinds of conversations you need to be having well in advance of trying to go to market, because at some point you run out of time and you run out of the ability to do those restructuring and to have those conversations after you're past LOI. Your entire focus and your whole team's focus is going to be getting across the finish line, and you don't really have the capacity as easily to make some of those maneuvers.
So if you are looking at selling a business, starting 2 years in advance is what I tell everybody, because you can have that 6 months due diligence of what you want to have happen. How do you want it to have happen? The other side I want to touch on is there efficiencies that, and I'm asking this rhetorically just so we can have that you can do inside of your business to make your valuations better?
Yeah, so there's quite a few things you can do, and part of it. So the way most of these businesses are valued, it's not all of them, but the way sort of general rule of thumb is they're going to look at your profitability. And there's a few different ways to measure profitability, but a very typical one in the M&A world is EBITDA. It's just for the simplicity's sake, it's a form of profit. And so what a buyer's going to look at is how profitable your company was over some preceding period, right? And so, and often that is a trailing 12 months. It's sometimes trailing 24 or 36 months. And so the earlier in advance that you can do some things to get your profit up. So if you have expenditures that maybe aren't necessary or typical, let's say that you are overstaffed in certain areas, the sooner that you can rectify some of those issues, the better your profitability is. And so whenever you apply a multiple to that profitability, if you have somebody who's, pulling a salary of $80,000 and you're able to kind of restructure that position to where you don't need that salary anymore, and then you multiply that savings over the course of 5x or 6x, now you've made a really big difference in sort of your ultimate purchase price. So that's one aspect of it. Similarly, if you can sort of accelerate bringing on clients with big long-term agreements, that's going to help your multiple. So those are all things that, sooner rather than later, you can kind of set yourself up, set your business up to look really, really good and really interesting and valuable to a potential buyer.
Yeah, I think that really hits the nail on the head, because a lot of business owners run fat, is what we call it.
Yeah.
Right? Because they enjoy life.
For sure.
It's good. They have great people that work for them. They built them. They have long-term relationships with those people. But it's a lot easier to turn around and say, hey, I'm going to have two people, right, do this job to make it where everybody's running 30% or 35% of their hours out of their week. They're not running 45%.
Right.
So everybody kind of has an easier day-to-day. But when you go into that M&A side and you're selling, you're trying to cut as much cost as you possibly can to get a higher valuation. And that's hard to do because people don't understand how to do it or where to do it or what to cut, what not to cut, right? You want to make sure that, and then it's getting in those long-term deals, right? Making yourself look as profitable as possibly can. That's ethically, that's sustainable. You don't want to, misconstrue it, but I think that's a big deal. So once you go to there, can you kind of speak to like valuations and how people look at it? Because there's asset-based valuations, right? Are people buying companies? Right? Or are they buying assets of companies and blue sky? Like what do you see the majority, and where's that? Because I think small businesses, you're buying asset value.
Right.
You're not buying companies.
Right. So most deals, especially in Texas, especially in the family-owned business, if you're saying less than, let's call it $100 million of enterprise value, kind of purchase price, right? Most of these deals are structured as asset purchases as opposed to equity purchases, which means, so the way I explain it to like my associates, let's say that there's a cardboard box, okay? And the cardboard box is your company. You can fill that cardboard box with a lot of stuff. So let's say that cardboard box is filled with your business's inventory and its, client contracts, and it's filled with its brand name and its recognition and its goodwill and its website, all of those things.
It's trucks, it's buildings.
Trucks,
it's
all of that stuff.
Yeah.
That's all the stuff inside the box. So most deals are structured as an asset purchase where I, as the seller, am going to pour out that cardboard box onto the table. And then you, the buyer, are going to pick through which of those things you want. And you're going to buy those things. That's the way most of these deals are structured. You can have an equity purchase, which is where instead of buying the stuff in the box, you are going to be buying the box. I just hand you the box. The box didn't change. That company is still the same. You're just holding the box instead of me. That's sort of the difference between an asset purchase and an equity purchase. Most of these deals are structured as an asset purchase. Now, as far as valuation goes,
why though?
Why? So buyers are going to want to have lower liability whenever they acquire a business. And typically, the way most of these deals work is a buyer is going to say, look, I only want to take the assets. I don't want to take any of the liabilities. I don't want any of the debt on this. I don't want any of the lawsuits or the obligations for the lawsuits. I just want to, so whenever you pour out that cardboard box, you're going to cherry pick the good stuff. You want the name brand recognition. You want those customer contracts. You want the good and interesting, profitable stuff. You want me to leave behind all of these things that you don't take. I have to take back. And that's going to be the debt on the company. That's going to be the, potential liabilities with lawsuits or something like that. And the way that this transaction works well between the two of us is if you give me enough money for it to justify you taking the good stuff, me keeping the bad stuff, I pay off the bad stuff. I pay off my loans. I pay off my debts. I settle my lawsuits. And then there's still enough left over for me to feel like I got a good transaction. So that's how that typically works in most of these deals, because you, the buyer, are going to prefer that. Now, there's other tax plays with depreciation and things like that.
I was fixing to ask you that, right? So whenever you make an asset purchase and you depreciated out all your equipment and your vehicles and everything that goes in there, and now all of a sudden they're buying those assets back from you, you have to recapture a lion's share of that depreciation. And so when I tell business owners, when you're ready to sell your business, you better be prepared for two things. One, it's probably not going to sell for the value you think it is. Right. So take 25% off that valuation.
Right.
Second is you're going to have to recapture depreciation there, which is another 25%.
Very likely. Yeah.
Right. And so, and if not, then you got to pay taxes on everything. Right. So the idea that you're going to walk away with 75, 80, 90% of the exit value of that business is probably not true. I tell people to plan on 50%.
And that's even before we get into any sort of complex structuring, right? So let's say in the hypothetical that we just talked about, that's if you're stroking me a check in cash. That's often not the case. A lot of the way these deals are structured is you're going to give me some cash, maybe 60%, 70% cash, but you're also going to want me to take a seller note to where I'm partially financing this, to where you still owe me more money later down the road. Maybe you want me to roll equity, which means that, let's say just for even numbers, you're going to buy my business for $10 million, but you're only going to give me $9 million. And then I'm going to take $1 million, the $1 million delta, and I'm going to invest that in your company and own 10% of the business.
Whatever the new business could be.
Right.
Knowing that you're going to try to double it or triple it.
Whenever you sell later down the road.
I get some more equity back out of it. So now the exiting CEO or owner has a vested interest to make sure the new company is successful.
The transition goes very smoothly.
It's usually 2 or 3 times. And I mean, 2 or 3 years they stay associated with it, and then they get another exit. And so that's good. You know, I will tell you I've seen them go as high as 40%. I've seen a lot of things into it. So I always advise clients, you need to look at this as two sides. One is there's no guarantees that he's going to run the company as good as you. Right. So you need to vet out. You're almost on the other side of this of being like a private investor into his company.
Right.
And you got to do due diligence in a completely separate manner now, saying, okay, what's your marketing plan? What are you going to do to grow this company? I know what it can do. I've done it for 40 years, right? But now I'm tied back into it. I don't have any equity, like I don't have any risk into it anymore, but I still have my time to make sure it's efficient for a couple of years. Right. So there's all this other risk that goes, and then are they well capitalized? Can they overcome, right? Are they pumping in a lot of cash to double or triple the sales of what this thing is? There's great opportunities. I've seen guys exit, and they actually get paid out the second time. 3 times higher than what their original buyout was, and they regretted not rolling more equity into the deal. Right now, that comes few and far between. I will tell you that comes few and far between. But
so one of the things so this kind of goes back to one of the things we were talking about earlier, is working with somebody like Alpha Capital is really, really, really important at that initial stage, because you have so much experience on doing this. You're going to be able to work with these clients to say, I know you think this company is worth $20 million, and I really hope you get a check for $20 million and that is in your pocket, no questions asked. However, based on my experience, I think you're going to actually get this amount less. Then you're going to have to pay taxes, and then you're going to have depreciation recapture. And then, some of that money is going to be on a seller note that you may or may not get. Some of that's going to be rolled equity that you may or may not get. Some of that's going to be on an earnout that you may or may not get. So now your $20 million check is really a $7 million check. And they can work with you to say, is $7 million guaranteed in your pocket enough for you to have the last chapter of your life, or the last, third of your life that you really want? Is that enough for you to hit your goals of buying a house in Colorado and going fishing with your grandkids? Is that enough? Because attorneys, we can't tell you that. As CPAs, most CPAs can't tell you that. They shouldn't be telling you that. But wealth advisors can. That is, a financial advisor should be able to help you look at what your goals are and what a potential liquidation event is, and be able to help model out what does worst case, mid case, and best case look like. And that's one of the reasons I like working with you. And you guys are able to help walk clients through that and make them feel comfortable, because that takes so much pressure and risk off of a deal, knowing that if the worst case happens and I don't get this seller finance and I don't get this earnout and I don't get this second bite of the apple on my rolled equity, I know I am okay. I have at least hit my minimum that I need to feel like I was successful in this transaction and successful in the sale. And I think that's huge.
Yeah, I would say 75 to 80% of the time, earnouts are the worst thing.
Right.
I would say people look at earnouts as like this huge carrot because they're presented as a massive carrot.
Yeah.
I've only seen one earnout actually work.
Yeah. I've seen many more than that, but from a percentage standpoint, it is the way I look at it. I tell clients,
they craft those earnouts to be incredibly
so
difficult
hard.
to hit. Those bogeys are so when you see earnouts, just automatically saying there's a 95% chance you're not going to hit
it. It's going to be winning the lottery. Yeah. Maybe if you go to Vegas, you'll come home with money, but most likely you won't.
Not, right? Yeah. And you got to remember they got an M&A guy like you if it's a serious buyer.
Yeah.
Right. Just like on the other side of that table that says, dude, if we get this, like we're going to hit a home run.
Right.
That's what we're putting into the earnout.
Yeah. They're not putting singles and doubles into the earnout. Those are the grand slams.
Yeah.
And everybody's rowing in the same direction. You all hope you hit it. They're not, but don't look at that. I tell clients not to look at $1 of earnout is the same as $1 of cash.
Yeah,
it's a nickel of cash.
It's a nickel of cash. 10% is max is what you look at into. And I always try to structure it like, hey, if they want this as their earnout, at least half of it needs to be somewhere below what. And you've run a business for a long time. You ran the business. Is that reasonable for you to hit that number?
Right.
You have to take basic logic into account on that side of it. All right. So now here's the other question. What is the legal language that gets people hung up that they screw up and they don't understand when they're looking at these documents to actually sell a business or buy a business or merge?
Yeah. So there's going to be a few things you're going to be really, really careful about. So most of an asset purchase agreement or stock purchase agreement, most of it is going to be, let's call this document 60 pages or so. 30 pages of it, 40 pages of it are going to be what are called reps and warranties of the seller. It's a bunch of promises that the seller is making about the business. Those are obviously extremely important, but they're understandable. You understand what's going on in your business and you understand how to make promises about, yes, these financial statements are correct. Yes, I promise that I have not had a lawsuit in the last 2 years. Yes, I promise that I'm not aware of any sort of hazardous material on my property. Those are easy, or at least simple to understand, right? So the things that people get tripped up on are things like net working capital. So net working capital is common in most of these transactions. And essentially that is money that a seller leaves behind in a business on behalf of the buyer. So the way I think of it and the way I talk to folks about it is kind of like if I buy a truck from you, right? And let's assume you're a dealership and not a private seller. If I go to a dealership and I buy a truck, I kind of expect that if I'm going to spend $70,000 on a truck, that it's going to be filled with gas, right? And that it's going to have new oil in it. And that if I give you $70,000, I'm not immediately going to have to turn around and fill it up with gas. So that's what net working capital is it's an amount of money that is left behind, kind of a reduction to the purchase price you can think of, that allows that buyer to operate that business for some period of time, typically around a month, without having to put in additional money. So that is one of the things that I talk to my sellers really early about, because that feels really wrong. That feels bad that you are leaving behind money. And you're like, hey, why am I giving you money? You're supposed to be giving me money. That's one thing. And then the other thing that you really, really, really work hard on are the indemnification provision. So this is worst case scenario. There ends up being a lawsuit after this transaction. What does that lawsuit look like? Who's obligated to pay what? What are the total maximum amounts? What are the sort of caps on liability that you can put on? Those are the provisions that I think any good seller should be chatting with their attorney about and making sure that their attorney really feels good and comfortable with those and can explain them simply, because it has a lot of experience knowing what the market bears right now. and based on this size transaction in this industry, this is market standard. This is something you can fight for. But in this market, something else is more typical. Having somebody who can kind of work with you on those, I think, is really, really important. Those types of provisions, because they are kind of specialist provisions that not everybody has experience in.
So lean into this a little bit. So I get questions a lot about AR and accounts payables and accounts receivables and how to square that.
Yeah.
So what do you see is most common is accounts payables, because you're pouring out the cardboard deal, right? You're taking back the payables, right? So you owe that debt inside of there. But are you taking also the receivables that debt was actually a part of?
So typically on your closing day, that's kind of your delineating line. And this also plays into this networking capital concept. So your closing day is sort of that delineating line. So you are typically a seller responsible for paying all AP incurred prior to that closing date. And you're also responsible, you also receive the benefit for the AR incurred before that closing date. So, but it's not typically, you don't necessarily know if I'm going to be closing on, April 1st, you don't necessarily know exactly what your AR and exactly what your AP is on that day. So you use this networking capital true up mechanism to where you kind of guess at that number on closing day, and then you have a true up over 90 days where the buyer and seller work together to kind of look back on April 1st. So with perfect clarity, April, May, June, I guess June, July, you'll look back on April 1st at what those numbers actually were, and then you have a true up between the buyer and the seller to if it was above or below whatever you kind of estimated on the closing date. So that's how AR and AP typically works. Which is a little bit different, right, than debt. So debt of a seller is almost always going to remain behind with the seller, and that is just a reduction of the purchase price. That is something that, these deals are cash-free, debt-free, so the seller typically takes all of the cash in the business on the closing date, but also is responsible for paying all of the debt. So those things are treated a little bit differently than AR and AP. But again, those are things that are really, really important to know and understand, because those can be huge swings, hundreds of thousands of dollars, millions of dollars swings.
Especially if it's a manufacturing company that takes
Absolutely.
a long time to collect on that AR. And you say that's the ones I see. They're like, holy crap, and then they have a lot of retained earnings in the company because it's manufacturing and there's a huge amount of capital inflows into it. Squaring that out, what do you see about inventory though?
So inventory is typically something you get sort of a dollar for dollar credit on. So that's so whenever you're calculating your net working capital, it's current assets minus current liabilities, and your inventory is treated as a current asset. It is sort of the same as cash. It's something that can be converted to cash very easily. So
do you see a lot of the buyers coming in on inventory and giving a discount rate depending upon how long those assets? Because you get into, and I'm talking about manufacturing a lot because that's one of the most capital intensive, right? But it's also the ones that are like, you have old inventory sitting on the
why has this been sitting around for 2 years?
Yeah, right. And so I'm not giving you full market value for this because that's probably not the sell for another 2 years.
Right.
And so there's a discount rate that
so
you
that's
apply to it.
Really, really typical. And I've got a couple of clients who work in sort of the protein space, the food space, and they'll, sell, frozen meat or frozen, produced foods. And those, even more so than manufacturing, I represent a lot of manufacturing companies, but even more so than those folks, they'll dig back in the freezer. The buyer will dig back in the freezer and find stuff that was on the inventory sheet, but has been sitting around past its due date, and
it's worth
nothing. It's zero. Yeah, you can't sell it. You wouldn't ever sell it. So all of that usually gets trued up in that kind of 90 days as well.
And you got to be careful because, when you go to your warranties and your caps and all your promissory stuff, and you say that inventory is there.
It's good,
and it's good, right?
Yeah.
Well, that's a lawsuit right there waiting to happen on the post-transaction.
Yeah, and I've been fortunate. My clients have been fortunate. We haven't had really it's very, very, very rare to ever have a lawsuit. But these are things that, typically get worked out, but it's still a reduction, right? You still have to true it up. You still have to have some sort of negotiation with them to say, yeah, kind of thought we had $2 million worth of inventory we're selling you. Kind of looks like it's really more like 1.7, and maybe we owe you a few $100,000. And there's ways that folks can get around that with indemnity holdbacks and stuff. But that's
Do you see that common? The holdbacks?
Yeah. So it depends on the size of the deal. But especially on sort of larger deals, it's pretty typical for a buyer to request, again, so simple numbers, right? $10 million, you're going to pay me $10 million for my business, but we're going to hold back $1 million. We're going to give you $9 million, but we're going to put $1 million into a third-party escrow. You don't control it. I don't control it. It just sits there. And over the course of a year or 18 months or 2 years, depending on how you negotiate it, that money's going to sit there. And as the buyer operates the business, if things pop up, if that inventory, you kind of go in and you look back in the freezer and you find out there's a bunch of stuff that you can't use, or if it turns out that there was a debt on the company that wasn't paid off, but it was a small debt, maybe there was a truck that had a note on it that you kind of forgot about. Those types of things, the buyer has $1 million that's already set aside to kind of cure some of those defaults. So they'll say, all right, well, $300,000 worth of inventory that was no good, and then $50,000 for paying off that car note. So we're going to take $350, we'll give you $650, and now everybody's cleaned up, and we don't have to get into a lawsuit over it.
Right.
So that's the way a lot of these deals will end up working.
That's crazy. So we covered a lot of the sell side.
Yeah.
Right. So talk about a little bit about the M&A side.
Yeah. So on the buy side, I represent a handful of private equity groups and family offices that and frankly, a lot of my family owned businesses often are sort of in the acquisition seat. So let's say you've got a really successful plumbing company or a really successful HVAC company or something like that. You're often, maybe your grand scheme is to sell the business, but in between now and when you're wanting to sell, you're often looking to go acquire other businesses. So I do a lot of buy side work as well. The same principles apply, but you kind of referenced this earlier. Having an attorney, most M&A attorneys work both sides of the table, depending on the client. Having somebody who understands kind of the buyer playbook and can use that on behalf of the seller whenever they're in the seller seat, and understands the seller playbook and is able to use that playbook, sort of the inverse of that playbook, whenever they're in the buyer seat, I think is really helpful. So there's not a huge difference in what you are doing on buyer or seller. It is the arguments that you're trying to make, and it is where you put a little bit more emphasis. So on the buyer side, you're going to be really focused as an attorney on disclosure schedules and due diligence, because the seller kind of knows their business. On the buy side, what you're buying is a bunch of promises about that business. You haven't run that business before. So buyers have to work with their attorneys very carefully to understand all of the skeletons in the closet, all of the documentation and the paperwork and the financials that go into that seller. So that is sort of one of the differences. But all of the other things we've been talking about, it's exactly the same. It's just arguing sort of the flip side of it for the same reasons we discussed. The same arguments kind of apply in inverse to the other side.
Yeah. So things that always get brought up when I'm on the other side where somebody's buying is they're buying half the time because they want to expand their margins, but also their top line revenue.
Right.
And it's an easy way to do that if I'm in the same industry and I'm just buying out a competitor, right?
Right.
But the other side that I find a lot of buyers doing now, they're doing it for almost like a tax arbitrage.
Yeah.
And so they're coming in and saying, hey, I can buy this other business. It's not my business, but it's kind of works alongside my business.
Yep.
But this has so much inventory in it, so much hard assets in it, so much of all these things. I don't feel like writing a $2 million check to the IRS.
Right.
So I can buy this business. I can do some type of cost segregation study or some type of accelerated depreciation.
Right.
And I can actually lower my tax liability, and I get to, pretty much buy this company at a 30% discount because of my tax liability. Do you see guys looking at it from those angles of just from I wouldn't say solely from a tax play, but it makes the deal look a little bit sweeter because of the tax benefits?
No, that's absolutely the case. So what I tell my buyers whenever they're kind of looking at that, whenever they're talking to their advisors, their other advisors, is never, ever buy a business specifically for that reason. But if you find a business that you would independently buy, but for that, that is such a huge, bonus. That is a big sweetener for it. So, but yes, folks are looking at that all the time. But I would, I tell my folks, don't get into something you're uncomfortable with just for the potential tax play.
Yeah.
Only do it if you would be happy to buy this business at this price. And then it's like Christmas morning that you get, you have some tax advantageous sort of maneuvers you can do.
I always say, hey, man, this is the sundae's got to taste really good. Here's the cherry on the top.
Exactly.
Right?
That's a good way to put it.
I also look at it from a standpoint, like I will find the grittiness of somebody winning the deal as a problem for people to actually closing deals. And I'm going, dude, you're a fraction of 1% away from where they're wanting to be at.
Right.
And you're not wanting to pay them an extra $50,000 or $500,000, but yet you haven't even considered that you're going to make $3-4 million in tax benefits
Right.
by doing that. So sometimes it takes the buyer, it helps me go like, okay, don't blow this deal up over a couple of $100,000.
Right.
Right. Because you're discounting that there is a cherry on the backside of this. Give a little bit here because typically the seller's going to be a lot happier for the next 6 months to 2 years. You still have to work with this man, right?
Yeah.
So if you rake him over the coals on the front end, don't expect a lot of charity on the back end when you still got to make sure the operations of the company works really, really well.
Exactly. And the most successful deals that I have seen while I've been doing this, the buyer and the seller like each other after these transactions. That doesn't always happen, but the ones that are successful, you have to have a kind of symbiotic relationship. If your buyer and seller end up hating each other 3 months after this deal closes or at closing, the likelihood of either of them being happy 2 years from now, 3 years from now, very, very, very low.
Yeah. It's tough. It's absolutely tough. But this is a great deep dive, man.
Yeah, I've enjoyed it. This has been a fun first podcast. Yeah.
Yeah. So it's hopefully we kind of shine some light on. I would say this is probably one of the most complicated. So before we leave, I got to ask you, what's one or two things that you say make sure that you do this on either transaction you have when you're exploring the right fit of the right people you want to work with, or it's just like, hey, make sure you don't trip over this when you're looking at an M&A transaction.
So I think we kind of touched on one of them is I think what all sellers or buyers, but we spent most of our time kind of talking about sellers. What you should be doing as a seller is you should be focusing on running your business, and you should be focused on getting the right team behind you and kind of letting them do all of the transaction stuff. Let them work on the M&A aspect of it, because what you are specialized in is running a very good and successful business. So I think the first thing is to put together a really good team, interview folks, trust your gut, talk to people, get good referrals. And I think putting a good team in place and then keeping your eye on the prize of running the business really well pre-closing is probably the advice that I would give folks. And don't try to do everything all at once. Don't try to be an expert in tax and an expert in M&A and an expert in investing your money and an expert in all of those things. Real estate. Yeah. You're not likely an expert in all of those things. So focus on your business, because sort of the other aspect we were talking about, kind of the buyer playbook and the seller playbook. Not all buyers do this, but a lot of buyers will say, we'll be in the process, the buyer and seller will be in a process for a year of buying and selling this business. And if the seller kind of takes their eye off the ball and is not managing and operating their business really well, because they're focused on selling the business, their profitability will slip, right? And so maybe you and I have an LOI where you're going to buy the business for $10 million, but that is kind of contingent on your business having $2 million of profit each year. But then over this last year, you kind of started thinking about the M&A work, and you were kind of, you're on the phone with attorneys all day and all night, and you're talking to your CPA, and maybe your profitability slips to 1.5 million. And so now we get closer to closing, your new, financials come out, and your buyer says, well, we were applying a X valuation to a $2 million profitability business. Now your profitability is 1.5. We're going to pay you $7.5 million. And so now, because you were trying to do a little bit of everything and you took your eye off the ball, now you lost yourself $2.5 million. So that's one of the things I would tell folks is put together a good team and then trust your team to do what they need to do, but also make sure that whatever team you put together feels really good about explaining complex conversations to you and topics to you, and that they are really, really responsive. I think that those are the things that you want in a good team is responsiveness and, the ability to kind of simplify the complex.
Yeah, simplify the complex is one of the biggest things I think you need to do. But building that trust is really, really, and having transparency in it up front. But that's a really great, man, I'm glad I had you on.
Man, I enjoyed this.
I talked you into doing this with me because it was kind of off the cuff, but I think a lot of people are going to see value from this. And how do people get a hold of you?
My law firm is Calhoun, Bella, and Seacrest in Dallas. My email address is sbryson@cbsattorneys.com. So always feel free to reach out. Happy to have conversations, kind of bounce ideas. The best part of my job is helping people. There's not a lot of opportunities for me to use the practice of law to help make people's lives better. But the M&A space, which is what I spend all my time doing, is one of those areas of law where I feel like you can really hop on a phone, make somebody feel really good and comfortable and, confident about a really scary, what could be otherwise a very scary,
it's a life-changing,
very anxiety-inducing kind of transaction.
I think you touched on one point, and I'll leave it here, is I think that you only do this.
Yeah,
You're not a generalist.
I'm not a generalist. So
you only do M&A work.
Yeah, so and the things that touch on M&A, right?
Yeah.
So I help buyers put together equity raises, and I help sellers and buyers restructure businesses, but all of it in the lens, in the context of mergers and acquisitions, buying and selling companies. That is my bread and butter. That's what I do day in and day out. And, there's one of the good things about being a specialist and being an M&A specialist is we love to work with sellers' general counsel. We do that all the time. And we are a good, teammate with them. We don't try to tell them that they're wrong. We don't try to tell them they can or can't do things. We like to be a good teammate with your existing legal team. We just like to be sort of a person who comes in with a particular specialty to work with your team, not to replace whoever it is you've been working with for a long time.
And that's a great point, because most attorneys that we deal with, we're like, man, that's a great attorney. Mm-hmm. He's been with you for 20 years.
Yeah, you don't want to get rid of that guy.
No, right? But his expertise isn't specifically in this one thing.
Exactly.
Let's make these guys work really, really well together. So,
yeah.
Spencer, thanks so much.
Thanks for having me on. I appreciate it. Yeah, absolutely.
See you next time.
All right.